If you own your own business and are self-employed, you may be wondering how hard it is to get a mortgage. This is Selland with Signet Mortgage, and today I'm going to talk about loan program options, qualifying, and requirements for self-employed borrowers. Traditional W-2 earners are generally able to qualify for a home loan by simply providing copies of W-2s, pay stubs, and assets, and only need tax returns if they have other qualifying income. During the process, we have to get verification of employment directly from an employer. However, when you own your own business, things become a little more complicated. In this message, we'll break down some of the general requirements in place for self-employed borrowers to qualify for a home loan. First, and especially important, is verification of how long you have been self-employed. Most lenders and loan programs require that you have been self-employed in your current business for a minimum of 2 years. Guidelines define self-employed as a borrower who has ownership interest of 25% or more in a business, or one who is not a W-2 employee. There's exceptions to the 2-year rule. You might even qualify for 1 year self-employment if you can show a 2-year history of a similar line of work. You need to document an equal or greater income in the new role compared to the W-2 position. Some lenders will even count 1 year of related employment plus 1 year of formal education or training as an acceptable work history. If you've been self-employed for less than 1 year, you will likely have to wait until you have 2 years documented self-employment, and that means filed tax returns with the IRS or an alternative way of documenting your income, which we'll cover a little bit later. Next, guidelines will generally consider any source of income that is stable, consistent, and ongoing. That means all kinds of self-employment income is eligible for mortgage financing, including, but not limited to, business owners, freelance income, contract work, seasonal work, and the gig work, side job kind of stuff. These types of income can be considered on their own or as additional funds on top of a primary job source like a W-2 job, but has to be consistent for 2 years. Lenders will sometimes even count unemployment compensation for contract or seasonal workers where regular documented history of receiving the unemployment in the off-season. For any source of income, a lender must determine it will be ongoing. Generally, this means income seems likely to continue for at least 3 years after closing. A history of declining income will likely be an issue unless we create a good story. For self-employed borrowers, a lender may conduct a review of the borrower's business to determine its stability and the likelihood of their income will continue at the same level. If you're in a declining industry, such as a hotel owner during the pandemic or a builder during a housing crash, this creates an additional hurdle to navigate successfully. Guidelines allow qualifying income for self-employed borrowers, starting with your taxable income, and then can add back certain expenses such as depreciation, since that's not a cash expense. Business owners and other self-employed workers are often take many deductions as they can, and while this can save you a lot of money come tax time, it can also hurt you when it comes to qualifying on your mortgage application. There are many new bank statement loan programs available today, and they're called non-qualified or non-QM mortgages. This means guidelines are outside of the Fannie-Freddie loan guidelines and will have slightly higher interest rates. So how can we document your income? In most cases, self-employed borrowers need to provide the following documents to prove their income in compliance with guidelines: 2 years of personal tax returns, 2 years of business tax returns, including schedules K1, 1120, and 1120S, a business license, year-to-date profit and loss, and a balance sheet, current balance sheet. Documentation such as a CPA letter or website proving you're still in business is required as well. These documents can be prepared by your CPA or a tax preparer or your internal financial department. If the business is a sole proprietorship and reported on Schedule C of your personal return and is not a partnership, corporation, or S-corp, you don't have to provide your business tax return. You don't have any. Back to the consistency of your income. If not regular and reliable, guidelines generally won't count it. That is where we help explaining how the business works and present it to the underwriters in the best light. You should be prepared to explain any significant year-over-year variation of income when you apply for a mortgage as a self-employed borrower. Guidelines will likely consider you self-employed if you own 25% or more of a business, if you do not receive W-2 forms, if you receive 1099s, you're a contractor or freelancer, and at least 25% percent of your income is from self-employment, or if you have income from dividends and interest. If you are a part owner of a business, but your share is less than 25%, you're not considered self-employed for home loan purposes. And remember, you are not required to use self-employment income under Fannie Freddie lending rules. If you have a freelance job or small business on the side, you don't need the income from it to qualify. We can ignore it on your application. However, if you have losses, we have to be able to explain how that doesn't impact your overall financial situation. You may be wondering if you can get a joint mortgage if one person is self-employed. Maybe you want to apply with a spouse or co-borrower, but one of you is self-employed and the other is traditionally employed. Lenders will be fine with this, provided the self-employment income meets the guidelines and both applicants meet the loan requirements. You also have the option not to count your co-borrower's income source if you wish. You may qualify for a loan with your own income and your co-borrower is self-employed. Your lender can ignore that business in underwriting. Why would you want them to ignore the business? Well, many small ventures or even larger startups don't show income on tax returns or at least on paper they generate losses. So we can work around that. While these businesses write-offs are great for taxes, they can reduce your qualifying or taxable income when you apply for a home financing. If you're self-employed and want to buy a home, it helps to plan in advance. Work with someone like us and involve your accountant early as well. Self-employed borrowers have access to the same mortgage programs and the same competitive rates as other borrowers in today's market. We have plenty of loan programs for options with self-employed borrowers. Thanks for watching. This is Clay Selland with Signet Mortgage. You can connect with me at the contact information below. Email address is clay@signetmortgage.com. Phone number is 925-807-1503. I look forward to speaking with you. Take care.